You're watching Personal Finance with Coach Kelvin. Let's get into the video. Hey guys, Coach Kelvin here. Now today I want to talk to you about basically how having any high interest and short-term debt lines or credit lines can be very detrimental to your investment journey or to your personal finance. Now, when we look at personal finance and investing, we're always worried about the percent return that we will receive for using our money to place into an asset class. However, when we look at debt, this is essentially a negative balance, okay? And for us to have that negative balance to actually use someone else's money, we owe interest on this. Now, whether that is the form of a personal loan, car loan, credit card, mortgage, etc., the interest rate will actually differ. Now, if we're expecting from the stock market returns from investing an 8% return per annum, we can comfortably say that we're likely to get a better return on investing our money doing this than say paying down a mortgage rate when it's locked in at 2.49% like my own, for example. That's a fairly safe assumption. However, the likelihood of us outperforming the market by trying to pick stocks and not just follow an index tracking ETF is very unlikely. And in fact, it's only around 1% of fund managers worldwide who are able to do this. So we're much better off buying a market tracking ETF. Now, some rare cases, people, yes, can outperform the market, but we are unlikely to be able to give a blanket rule to everyone where they can do so. Therefore, we're going to assume that stock market investing long-term returns about 8% for the simplicity of this video. Now, if you have any debt attached to your name outside of, say, a house, because as I said, mortgage repayments right now on low interest rates are extremely low. There are people with under 2% interest rates. I'm at 2.49 myself, and I know a lot of other people who are actually on a really low rate. Therefore, you don't need to worry about this so much. It's sort of in line with inflation there. However, if you have personal loans, car loans, short-term debt like credit cards or buy now, pay later services that you cannot service, there's a huge likelihood that you're going to actually limit or inhibit your returns, because this debt is like biting at your Achilles heel every time, preventing you from progressing forwards. So if we look at the sort of standard credit card advanced cash rate, which is about 21% here in Australia, okay, for me to get a 21% return on the investments I'm making, I'm going to be at about 2.5 times the annualized return of what the share market returns, okay? So I would need to be a very successful, long-term, active investor, not passive. So it's going to take a lot of time to research my stocks, to make sure that I'm screening them well, buying in at a margin of safety price, etc. So to assume that we can outperform the interest rate of our credit cards with our stock market investing, that's actually a little arrogant, and it's unlikely that we'll probably be able to do that. So I want to talk to you about two different methods or two different programs you can use for paying down debt, okay? So there's essentially two camps here. We have debt Avalanche and we have debt Snowball, okay? Now, debt Avalanche is basically an aggressive method where you take your minimum repayment on every single loan, okay? And then any remaining funds you place into the highest interest loan that you have, or the highest interest account. So if I had a personal loan at 9% and a credit card at 21%, I'm going to divert just the absolute minimum on the 9% personal loan, and then I'm going to funnel all the resources I have onto that 21% credit card. So it may look like this. If my personal loan had a minimum repayment of $100 a week, okay, but my credit card had about, $35 a week, okay? So my total weekly requirement to pay, or per month if you want to work it out this way, but weekly works for most people, would be $135. Now, there's no point me trying to get stock market returns and investing when I've got this debt to service first. So what I would do is take my $100, drop it onto the personal loan, my $35, drop it on the credit card. Then any remaining funds I have outside of my normal expenditure habits, or if I can reduce some of that to funnel more money into these debts, I will. So I'll take that 21% credit card and just go hard at it, putting all my remaining funds into it. I'll deploy them like my own little army to try and drop down the cost of that credit card. Now, some things that aren't also included in that percentage are the annual rate or the annual fee of that credit card. And if you have any times where you've had to actually withdraw cash, or you forget the payment and you miss a month, then you're going to actually have a bill for not paying the minimum amount. So this all has a negative impact on your returns. Therefore, the debt avalanche method is probably the most aggressive and the fastest way to get yourself out of debt. Plus, the psychological benefit at the end is wonderful, because when you pay off that highest interest rate credit first, you're going to be a lot more relaxed and you're going to have a lot more funds to deploy into the lower interest credit, because you've been losing a lot more money to that higher return. Now, I'm going to take you through the debt snowball method. Now, this is one where we're paying off our debt, but with more of a psychological advantage than aiming for the highest interest rate. So what we're doing here is looking at the lowest balance first. So something you could do, for example, okay, let's say you had those two loans that I mentioned, all right, and let's say the value of the personal loan was $10,000 and the remaining balance on the credit card was $20,000. So you had a debt total of $30,000 to pay off. All right. Despite the personal loan being a lower interest rate, I'm going to deploy all my remaining funds into that, because I want to pay that down as soon as possible, just for the psychological win of only having one credit line and not two, because that second credit line will stress me. It might affect my ability to sleep. And, you know, getting that smaller debt paid off first is a little victory that you can celebrate by then deploying more funds into the larger credit line. So when I have eventually paid off that personal loan for $10,000, all my interest and principal requirement to pay for that, I can now deploy onto that credit card. And because I'm actually losing less money every month or every year, because I now have a reduced or removed credit line, I'm going to have more funds to deploy into that credit card. Now, like I mentioned before with the debt avalanche method, all right, you're still going to lose more money on the higher interest loan, but if that is the higher debt credit line, you're going to take a bit longer to pay it down. Plus, paying off that smaller one gives you that little internal victory and that positive self-talk that what you're doing is correct. So using these two methods, we can attack our debts in an efficient and a well-calculated way, because any spare funds that we have, we deploy onto the loan, which requires our attention based on our strategy. If I, however, just chose to dabble, an extra $5 in here and here, then I'm not really making any headway onto either of those credit lines. So by being aggressive on one, getting that out of the way, and then deploying all of the funds or resources I had over here into the opposing credit line, I'm going to be back on top of my debt. Now, if you have lots and lots of debt in different places, being able to manage all these loans with the debt snowball method may be very difficult, because even though there's different balances and you can actually, pay off the smaller one first and move to the next and follow that hierarchy of dollar amount for each loan or each credit line, even though you can technically do that, it can be very stressful to manage so many outstanding balances. So another thing we can look at doing, okay, is going into a debt consolidation loan. Now, what you can do with this is take out one loan, which basically covers all of the cost or all of the interest and credit repayments to pay out completely all of the other loans that you take out. Now, the psychological benefit of this is that you're only going to be left with a single loan to pay down. And yes, taking out a new loan may have account establishment fees, any extra payments or anything like that to get started because the balance is so high. But then all of the funds you were deploying into all these different little areas are now getting funneled into that one debt consolidation loan. And I can tell you for my experience, I've never had to do this, but speaking with other people who have, they feel much more relaxed, only needing to manage one credit line and not multiples, okay? So this can be an extremely effective way to get back on top of your finances. Now, if you're able to take out a debt consolidation loan at a lower interest rate than what you're paying any of your other credit lines at, this is also going to save you some money. So for example, if you're paying a 21% credit card and a 10% personal loan, okay, and you can get a 9% debt consolidation loan, this is a wonderful way to get back on top of things, because not only is your monthly requirement going to be less to service that loan, you could potentially choose a longer term so you have longer to pay it off, and you're going to actually have the flexibility of only needing to pay one loan and not multiple, okay? So debt consolidation loans can be very psychologically effective here, especially if you can take it out at a lower interest rate than your other debt obligations. So taking a method of approach like this, whilst it does take some risks and it can affect your credit score simply just paying out another debt with a loan you've made, getting on top of your finances like this and being able to recruit all of your funds to pay down these debts as fast as possible is going to allow you to then get back to a zero balance and then try and grow your net worth over time, investing all of that money as you go, using the strategy I've spoken about in previous videos of dollar cost averaging. Now, like I said, using this strategy of dollar cost averaging, we're going to be deploying our funds at the same time in a particular time period into our investment portfolio and growing it. Now, the returns we get when we're at zero outstanding debt, if we're getting those 8% market returns, that is a phenomenal return. But an 8% return, if you had a 9% personal loan or even a 21% credit card, we're actually then in a negative return. So having invested money instead of paying down my debt, I would slowly be going backwards, okay? And it's important to realize this. So I hope today you've learnt a little bit about those two methods of paying down your debt. We have the debt avalanche and the debt snowball. Both are very effective. One is more for the savings and one is more for the psychological benefit of having fewer lines of credit to pay off. If you go down the route of doing debt consolidation, you can find a peer-to-peer lending platform such as Plenty, which I do also invest in. And taking out a personal loan through a platform like this is actually a wonderful way to go about this, because you may be able to find yourself and secure a loan that is cheaper than a bank, who has to pay for a lot more overheads to be able to service that loan, to help you service that loan. All right, guys, so if you got any value from this video, please like, share, and subscribe. And if you can leave a comment about your experience of paying off debt and how that benefited you, that would be wonderful. Guys, I look forward to seeing you in the next video.